The IRS just released the 2026 contribution limits for health savings account or HSA, and they release these new numbers around April or May of every year. But there's something else going on in Congress at the time I'm recording this video, and that's the big, beautiful bill they're looking to pass in June, which includes the proposals to improve the health savings account. So in this video, I'm going to cover two parts. What will definitely happen in the HSA starting on January 1st, 2026, and what might happen to the HSA starting in 2026 and 2027, according to the latest tax bill. And I'll leave chapters in this video so you can navigate every HSA benefit that's being proposed in Congress in the second part of this video. But anyway, let's break it all down. For those of you with self-only coverage under a high-deductible health plan, which is the fancy name for an HSA eligible plan, the limit is jumping to $4,400 in 2026. That's a $100 increase from 2025's number of $4,300. Now, $100 might not sound like a huge number, right? But think of it this way. There's an extra $100 you can stash away in a pre-tax contribution where you can grow tax-free and be withdrawn tax-free for qualified medical expenses. I don't know if you knew this, but only 8% of Americans actually know to invest in the HSA so that they can secure their retirement with this healthcare investment vehicle. Are you one of the 8%? I'd love to know in the comment section down below. And for those with an HSA family plan, the limit for 2026 is hitting $8,750. And that's a sweet $200 jump from 2025's $8,550. Again, $200 might seem like a drop in the bucket, but imagine if you consistently max out these limits year after year. We're talking thousands, and then tens of thousands, and then eventually hundreds of thousands sitting there compounding and ready for these unexpected healthcare expenses as you get older. And I have a very comprehensive HSA calculator for my course members and my private clients that you can check out by visiting firesightshare.com/fireinvesting or firesightshare.com/private clients. And HSA is a triple tax advantage account, but I think we should call this the quadruple tax advantage investment account. And here's why. Every dollar you put into the HSA is in pre-tax dollars, which means it will lower your taxable income between federal and state income taxes. Unless you live in California or New Jersey, then you don't get to deduct your state income tax. So if you're mad about that, you should contact your state government officials. But anyway, every dollar you put into the HSA will also grow tax-free like a Roth IRA. So you're not going to get a tax form every single year saying that you owe capital gains or dividend taxes. And every dollar you withdrew from your HSA for a qualified medical expense is also tax-free. But wait, that's just three tax advantages, right? The fourth tax advantage you have is if you contribute to your HSA directly from your paycheck, also known as the HSA deferrals, then you can deduct your Social Security at 6.2% and Medicare taxes at 1.45%. And that's why I call this investment vehicle a quadruple tax advantage investment account. So let me give you an example. Let's say you contribute $4,400 in the year 2026. The marginal tax rate for your federal income tax is at 22%. The marginal tax rate for your state income tax is at 5%. And you have another 7.65% in Social Security and Medicare taxes, also known as payroll tax. And that's a total of 34.65% that you could save from that $4,400 that you contribute in the year 2026. We're saving you a total of $1,524.60. I don't know about you, but I like to keep more money in my pocket instead of going to the IRS. But a word of caution here, and there are tax penalties too if you don't do this correctly. If you pull HSA money for non-medical expenses before you turn 65, the IRS will take 20% right off the top, and that's in addition to the federal and state income taxes. After 65, you can use it for anything without the penalty, but you will pay taxes if it's not for medical use. So I treat this investment account like a traditional IRA, knowing that I will owe income taxes after I turn 65. So think of it like a hybrid between a retirement account and a healthcare fund. And if you're not sure what qualifies as an HSA medical expense, you can visit the IRS website to look at the entire list. But just in case you're struggling with all these details and rules, you can drop by firesidechat.com/consultation anytime to schedule a one-on-one consultation with me, and I'll gladly help you out. And did you know that an HSA also comes with a $1,000 catch-up contribution limit like the Roth IRA? But keep in mind that you have to be at least 55 years old, or if you're turning 55 sometime in the same calendar year. So if you're 54 right now in May, but you're not turning 55 until December, you can still put that extra $1,000 into the HSA because you're technically 55 in the calendar year in the eyes of the IRS. That makes sense so far, right? And what's really awesome about the HSA is that you can get an employer match like your 401k if your employer does allow it, but you have to deduct that employer match from the total contribution limit. So if you have $4,400 that you want to invest and the employer wants to match $1,000, then your portion is just going to be $3,400. And besides all that, my wife and I save every single medical, dental, and vision receipt so that we can reimburse ourselves later with the HSA, regardless of our age, and take them out tax-free and penalty-free because those receipts have no expiration dates. And there's no expiration date on when we need to take the distributions out of the HSA. And you can check out this video I did on the HSA strategy for early retirees, linked in the description below. But anyway, here are some additional numbers you need to know before I go over what's being proposed in Congress. And because these numbers do matter for what I'm about to go over later on in this video. First, there's the maximum annual out-of-pocket expenses. And this is the most you will have to pay in a plan year for covered in-network services. Think deductibles, co-pays, co-insurance, but not your premiums. For self-only coverage, this limit is increasing to $8,500 in 2026, up from $8,300 in 2025. For family coverage, it is now $17,000 in 2026, up from $16,600 in 2025. So this is your safety net, your financial ceiling for medical costs within a given year. Then there's the minimum annual deductible, which means the amount of money you pay for healthcare expenses and services per year before your healthcare plan starts to pay. For self-only coverage, that minimum is taken up to $1,700 for 2026, up from $1,650 in 2025. And for family coverage, it is rising to $3,400, up from $3,300 in 2025. And again, this is the amount you typically have to pay out of pocket before your insurance starts to kick in for most services. And before I get into what's being proposed in Congress, I need you to have a very clear understanding of how you become eligible to open an HSA and contribute to it. Because if you don't understand the basics, you're not going to understand the changes. So to qualify for an HSA, you must be covered by a high deductible health plan. You cannot have any other health coverage or be covered under your spouse's plan. So if you're on TRICARE, you're not going to be eligible for an HSA because it's not a high deductible health plan. And if you are covered under your spouse's healthcare plan, then you're not going to be eligible for an HSA. And you also cannot be claimed as a dependent on someone else's tax return. And you also cannot be enrolled in Medicare. However, you can use your existing HSA funds to pay for premiums for Medicare Parts A, B, C, and D. You just cannot contribute to the HSA while you're covered by Medicare, but you can use your HSA to pay for your Medicare expenses and premiums, which can increase your take-home pay for your Social Security retirement benefits. But there's something being proposed in the big, beautiful bill, and I will go over that later on in this video about Medicare and HSA. So here's the thing. Not every plan with a high deductible is HSA eligible, and so your plan has to be officially recognized as such. So check your health plan documents or bug your HR department, maybe after they've had their morning coffee. You know how these HR people get without their coffee. And here's another gem about the HSA. And HSA contributions follow the tax year, not the calendar year. What does that mean for you? It means you've got until April 15th, 2027 to make contributions for the 2026 tax year, just like your Roth IRA, right? So even if you forget to max out your HSA by December 31st, you still have a few extra months to catch up before tax day rolls around. And it's especially helpful if you get a year-end bonus or an early tax refund and want to funnel a little extra into your HSA. Oh, and don't forget about the HSA last month rule. And it's a little neat trick. And if you're HSA eligible on December 1st of a given year, you're treated as eligible for the entire year. So you can contribute the full annual limit. And just make sure you stay eligible through the next 12 months, or else you're going to owe taxes and a penalty on the excessive contributions calculated on the IRS website. So let me give you an example. Let's say you become eligible for HSA on December 1st, 2025 with the family HDHP coverage. And under the last month rule, you contribute $8,550 to your HSA under the 2025 tax year. From that point forward, you're going to be under what's called a testing period, which means that you have to be under the HDHP coverage for the next 12 months from December 1st, 2025 to December 1st, 2026. But let's say you became ineligible for the HDHP coverage in June 2026, then you failed the testing period, which means the majority of that 8,550 that you contributed back in December 2025 will become taxable income with a 10% penalty. So if you divide $8,550 by 12 months, that's $712.50. You're going to subtract $712.50 from December 2025 from the $8,550 that you contributed in December. So $7,837.50 will need to be in your gross income on your 2026 tax return, which charges your federal income tax, state income tax, and a 10% penalty. So you have to be very careful with this testing period, especially if you're switching from the self-only or individual coverage to the family coverage during the first year. This could result in devastating consequences with taxes and penalties, so make sure to follow the IRS guidelines if you have any questions on the last month rule. And please don't confuse HSAs with FSAs. And I've seen this mix up so many times with my clients. So here's what you need to keep in mind. HSAs are yours to keep. You don't lose the money at the end of the year. It rolls over, it grows, and you can invest it. If you quit your job, you get to keep your HSA. If you retire from your job, you still get to keep your HSA. And I treat my HSA like a traditional IRA or a Roth IRA because I want my future healthcare expenses to grow tax-free in my HSA. FSAs, on the other hand, it's use it or lose it. It's like a health savings Cinderella story. Once the year ends, the coach turns back into a pumpkin. And there's a carryover limit of $660 for the FSA. But get this, if you quit your job and you have a remaining balance on your FSA, you basically donate that money to your employer. Yes, that's your money going to your employer if you have a remaining balance. You cannot use the FSA after your last day of work unless you qualify for COBRA continuation coverage. I don't want to talk too much about the FSA in this video, but the bottom line is that HSAs are the true MVP of tax advantage accounts with quadruple tax benefits. Now, let's get into the juicy part. And everything we've talked about so far, those were the basics. These are the changes. So Congress is proposing several new HSA rules, and the proposed legislation is part of Section 110000, that's a lot of zeros, of the Consolidated Appropriations Act, also known as the Big Beautiful Bill. And if it passes, here are the big items that you need to know. Let's start with Section 110213, bigger HSA contributions for certain individuals. So you can find this on page 845, and I'll put the tax bill in the description below. And this section proposes letting individuals under a certain income threshold contribute even more to their HSAs, which is on top of the current limits. Remember when I went over the maximum out-of-pocket expenses for 2026? This new HSA limit will almost match those numbers I went over earlier. And mark your calendar because these expanded contribution limits will not kick in right away. If passed, the changes would officially take effect starting on January 1st, 2027. But here's the kicker. There's an income phase-out range that I'm not a fan of, but let me go over it anyway. So, if you're earning above a certain amount, your extra contribution room gradually disappears. So, if you got self only coverage or an individual coverage and your income is below $75,000, you may qualify for an additional 4,300 in HSA contributions each year. That's on top of the regular annual limit. So, we don't know what that regular limit is going to be for 2027, but it's 4,400 for 2026. So that 4,300 is going to be on top of that 4,400. And this bonus phases out gradually and disappears once your income hits $100,000. So if your income is going to be 87,500 in between that income phase out range, then you can only contribute 50% of that additional limit of 4,300 or $2,150. So if you're in that sweet spot, it's a great chance to maximize your tax advantage savings. Now, for those with family coverage, the proposed legislation could allow an extra $8,550 in HSA contributions. Again, we don't know what the standard HSA limits will be in 2027, but the 2026 family limit is $8,750. So that $8,550 is going to be on top of that $8,750, not adjusted for inflation in 2027. However, that's only if your household income is under $150,000 filing taxes jointly. And the phase out begins above that and cuts off entirely at $200,000. For families juggling healthcare and long term savings, this could be a huge game changer. And the next one is section 110209 on page 837, which allows both spouses to make catch up contributions in the same HSA. Right now, if you're 55 or older, you can contribute that extra $1,000. But if your spouse is also 55 or older, your spouse would need a separate HSA just for them to make their catch up contributions, which is a pretty dumb rule that we have now. And this bill would change that. And page 837 says couples could both make catch up contributions to one shared HSA. Finally, some common sense, right? Because let's be honest, not all married couples have multiple jobs with high deductible health plans. And this change is long overdue. And it was one of the items I wrote to Congress about way back in February. And moving forward to section 110204 on page 824, this section would let individuals who are enrolled in Medicare continue contributing to their HSAs. So if you watched the earlier part of this video, I talked about how you can pay for Medicare premiums and expenses with your HSA, but you cannot contribute to it while you're enrolled in Medicare. However, this new bill will allow individuals enrolled in Medicare to continue contributing to their HSAs. For retirees who are still working or maybe consulting part-time, this could be a significant advantage. Now, let's move on to section 110210 on page 839. And this section will allow individuals to roll over their terminated FSA and HRA over to their HSA. So right now, FSA and HRA money don't mix with HSA territory. But under this change, you'll be allowed to roll over funds from a flexible spending account or health reimbursement arrangement directly into your HSA. So think of it as a fusion of health accounts, right? It's pretty cool if you have unused funds and want to consolidate them, right? And remember, I said what I said earlier, that FSA money can go back into your employer. This new bill will allow you to transfer your FSA funds over to your HSA. And moving on to section 110211 on page 843, which is a special rule to allow you to pay for medical expenses before your HSA was established. And I'm a fan of this one. And today, right now, HSA money can only be used for qualified medical expenses after the account is open. But under this proposal, you'd be able to reimburse yourself for certain medical costs, even if they happen 60 days before the HSA was officially established. So as long as it was in the same year and tied to HDHP coverage. And this could be a game changer for the HSA last month rule, and I talked about earlier in this video. And this proposal states that treatment of certain medical expenses incurred before establishment of the account. So if an HSA is established during the 60-day period beginning on the date that coverage of the account, beneficiary under a high deductible health plan begins, then solely for purposes of determining whether an amount it paid is used for a qualified medical expense. Such account shall be treated as having been established on the date that such coverage begins. All right, let's go to section 110212 on page 843 and 844. And this proposal will allow you to make HSA contributions even if your spouse has an FSA or a flexible spending arrangement. So at the time I'm recording this video, if your spouse has a general purpose FSA, even just $100 in there, it disqualifies you from contributing to an HSA. It's a stupid rule that's been around for ages. And this section would nix that rule. So spouses could mix and match benefits without tripping over each other's plans. And then there's section 110208 on page 832. And this is a fun one. And it states that certain amounts paid for physical activity, fitness, and exercises are treated as amounts paid for medical care. So this section says that certain fitness related costs like gym memberships, fitness classes, and even at home exercise equipment could be treated as qualified medical expenses. Does this mean you can pay for your yoga mat and a Peloton with tax-free dollars? We'll see what the IRS says first when the list comes out and if this proposal even passes in Congress. We'll see about that, right? Maybe it will. And there's also section 110206, bronze and catastrophic plans are going to be allowed to contribute to their HSA. So right now, not all of them make the cut, but this would widen the field and give more people access to the HSA club. And trust me, it's a good club worth joining. And I'm glad they added this because I wrote this to Congress back in February about adding this to the plan. So here's a word of encouragement. The 2026 changes that are already locked in, don't wait around. Get ahead of them. Adjust your contributions. Rework your savings game plan. And these new limits are not just numbers. They're opportunities to protect your health, grow your wealth, and get one step closer to financial peace of mind. And if you're not using an HSA yet, you can always look at your current healthcare plan to find out if you're already eligible. But not everyone should use an HSA because you may be someone who spends a significant amount of money on medical expenses already. So maybe an HSA might not be right for you. And remember, the HSA is not just another savings account. It's one of the most powerful tax advantage tools that we've got. Now, as for the proposed changes, stay tuned and stay hopeful because what's being discussed in Congress could make HSAs even more inclusive, more flexible, and way more aligned with real life needs, whether you're starting out, raising a family, or navigating retirement. After all, this is your money, your health, your future, and you've got more power to shape it than you think. And this has been another beast of a video, and I hope you got a lot out of it.